Hello, everyone, and welcome back to the Deep Dive. I hope you are having an exceptional week and are ready to tackle one of the most critical yet often misunderstood sectors in global technology.
Indeed. We're diving deep into the engine room of the digital world.
We really are.
This is the place where the true physics of Moore's Law are actually executed.
Exactly. Today, we are undertaking an exhaustive deep dive into Lam Research, ticker symbol LRCX. Lam is, it's absolutely central to the story of modern computing.
It really is.
It sits squarely at the intersection of material science and, well, atomic-level fabrication. They are one of the indispensable producers of wafer fabrication equipment, WFE, with, frankly, undisputed dominance in the absolutely critical steps of etch and deposition technology.
And this leads us right to the core investment dilemma. It's the question that every long-term capital allocator has to answer when they look at this company.
Which is that fundamental trade-off, isn't it? Quality versus price.
Precisely. On one hand, Lam Research is, without a doubt, an indispensable engine of Moore's Law. It enables the kind of complexity and density that drives innovation in AI, cloud computing, everything.
Right.
But on the other hand, its stock price is famously subject to, that inherent cyclicality in the semiconductor equipment market. And perhaps more acutely today, it faces major structural geopolitical risks tied to global trade.
So the central question for you, the long-term investor, is this. Is Lam Research truly a durable, irreplaceable Tollbridge compounder? Is its long-term growth superior enough to override that inevitable short-term volatility?
Or is it just too constrained by these massive macro forces to be a core permanent holding in a portfolio? That's what we're going to spend the next 40 minutes or so trying to unpack. That is a massive question, and it's one that requires us to look far beyond, the typical quarterly report. And before we get into the weeds, into the details of the competitive moat and the technology, just a quick note for everyone following along with us.
Yeah, for those of you who want to act on these investing ideas or, frankly, just want a professional-grade platform for managing your own holdings, having the right brokerage is, well, it's key. We use Interactive Brokers. They're consistently top-rated for sophisticated investors, especially with their global access and low margins.
And we've partnered with them.
We have. We've partnered with them to get our listeners an exclusive stock bonus when you sign up using our affiliate link.
So you get a powerful platform, a stock bonus, and you support the channel that brought you this detailed analysis all at the same time. That link is right there in the description below, right?
That's right. It's right there. It's the easiest way to stack the deck in your favor. And of course, if you find value in this kind of in-depth, long-form discussion, the kind that truly helps you understand the inner workings of a business, the best way to let us know is to subscribe and hit that like button.
It really does help the channel grow.
It does. And we read every single comment. So if you have any questions at all regarding Lam Research or the WFE space, please drop them in the comment section below.
Perfect. Now, let's turn our attention to the physics of this business. We'll start with pillar number 1, the competitive fortress and business model.
Let's do it. And let's initiate this discussion by going right back to basics, because I think understanding what Lam Research sells is absolutely fundamental to understanding its economic moat.
Absolutely. So at its core, Lam Research designs, manufactures, and services what's called wafer fabrication equipment, WFE.
WFE. That's the capital equipment, the big machines.
The really big machines. But, and this is the key distinction, they aren't generalists. They're not trying to do everything for everybody in the semiconductor fab. They are specialized masters of two very specific things: material removal and material addition at microscopic level.
That specialization is so important to understand. They don't just build any tools. They specialize in the most critical, the most high-intensity steps of making a chip.
The steps that really determine the ultimate performance and, crucially, the yield. So Lam is the market leader, the undisputed market leader in the complex process of etch. And they hold a very strong, often number 2, position in deposition.
We hear those terms all the time, etch and deposition. But for everyone listening, let's just make sure we understand the sheer difficulty involved here. What is etch exactly?
Etch is essentially the process of precisely carving microscopic circuits onto the silicon wafer. It's often done using highly controlled plasma.
So think of it like a sculptor.
Exactly, but it's a sculptor using an invisible plasma chisel that has to have atomic-level precision. It's unimaginably precise.
And if etch is taking material away?
Deposition is adding it back. Deposition is the process of precisely adding ultra-thin layers of material things like metals, oxides, nitrides back onto the wafer. And these layers can be just a few atoms thick.
Wow.
It's like spraying paint that is completely invisible to the human eye, but which has to be absolutely perfectly uniform across an entire 300-millimeter wafer.
So companies like TSMC, Samsung, Micron, they're completely reliant on this kind of specialized equipment to execute their designs, especially at the cutting edge.
They cannot do it without them.
Okay, so when we look at their revenue, it seems like there are two clear streams. And one is, well, it's significantly higher quality than the other, isn't it?
Oh, absolutely. The first stream, the one that's most visible, but also the most cyclical, is system sales.
These are the sales of brand new WFE tools.
Exactly. The big, shiny, new machines. And these sales are inherently cyclical. They peak when chipmakers are expanding capacity or transitioning to a new technology node, like moving from, say, a 5-nanometer process to a 3-nanometer process.
And the second stream?
The second stream is the source of the business's surprising durability. It's a Customer Support Business Group, or CSBG.
The CSBG. Now, you've called this the hidden profit engine before. We really need to detail why its margins are so much better.
It is the absolute definition of a razor and blade model, just applied to incredibly deep technology. The system sales are like selling the multi-million-dollar etcher.
Okay.
But the CSBG provides the blades, the services, the spare parts, the consumables, and the high-margin refurbishment that are all necessary to keep that enormous installed base of Lam equipment running 24/7.
So this is the high-margin, sticky, recurring revenue stream.
That's it. And because those parts and services are proprietary, they're required for yield, and they're tied to these very specialized process flows, the margins are just excellent. They're far superior to the upfront system sales.
So just be clear, the system sales drive the revenue growth and the market share.
Right.
But the CSBG provides that crucial profitability floor during the cyclical downturns. It mitigates some of that traditional WFE volatility.
You've nailed it. When system sales drop by, say, 20% in a downturn, the CSBG revenue might only dip slightly, or in some cases, even remain flat.
Why is that?
It's because of the sheer size of the installed base. All those machines out there in the world still need maintenance, they still need spare parts, they still need software upgrades to keep running. This structural hedge is a key reason why Lam's financials are so much more resilient than, say, a generic industrial capital equipment supplier.
And when we talk about the stability and endurance of this business, we have to look out, 10 or even 20 years. What are the fundamental non-negotiable forces guaranteeing that this model will even endure?
It's rooted in two, I would say, non-negotiable forces that are driving our hunger for computation. First is the persistence of Moore's law.
It's not dead yet.
It is not dead. The fundamental demand for smaller, more powerful, and more complex chips, which is being driven by this explosion in AI training, cloud infrastructure, 5G, that is not a fad. It's an enduring global requirement. Lam is enabling the very physics that allows Moore's law to continue, even as physical scaling gets exponentially harder.
And the second force?
The second force is simply the continuous, increasing human demand for compute. I mean, as long as global society demands faster processing, better AI models, pervasive connectivity, and massive cheap data storage from hyperscalers all the way down to autonomous vehicles, Lam is an indispensable enabler.
They're sort of riding this secular, multi-decade wave of digitalization.
That's a great way to put it. They are, in effect, the arms dealer for the entire digital revolution, and every single weapon needs their specific equipment to be forged.
That brings us squarely to the economic moat then. The competitive fortress they built around these core technologies. This is where we can really confirm that Tollbridge concept.
It is. The moat here is built on incredibly high switching costs and intangible assets, primarily their proprietary technology, and, thousands of patents and things like plasma etch.
But let's make it real for the listener. To really understand the moat, you have to picture a semiconductor fabrication plant, a fab. These are not just factories.
Yeah.
These are multi-billion-dollar pristine facilities, almost like laboratories on a massive scale.
We're talking about an 8 to 10-figure capital investment per fab. And once a Lam tool, an etcher, or a deposition system is integrated into that fabrication line, it becomes deeply physically and technically embedded.
What do you mean by embedded?
Well, the entire chip recipe, the sequence of Hundreds of steps, the specific gas mixtures, the yield optimization, it's all finely tuned, sometimes over years, to the exact specifications and performance characteristics of that one specific Lam tool.
So the idea that a customer could just swap out a tool for competitors.
It's technologically irresponsible. It's an unacceptable risk to switch, and that right there is the Tollbridge.
So what would happen if a chip maker tried to replace a Lam etcher with a machine from a competitor?
The chip recipe would break instantly. It would necessitate a costly, multi-year, highly risky requalification process for the entire device architecture.
You'd have to start from scratch.
Pretty much. And you would be potentially jeopardizing billions in planned production and damaging years of reputation. Given that the fab is meant to churn out billions of dollars in high-margin chips, the idea of risking that output just to save a marginal cost on the equipment purchase it's just not feasible.
So Lam is selling a very high-cost component, but that component is actually a tiny fraction of the chip maker's total final product cost.
Exactly. It might be just a few cents per finished chip.
But it's absolutely critical to the success of that multi-billion-dollar operation. The customer has to pay Lam's margin, their toll, because if they don't, their fab sits idle, or worse, it produces defective chips.
And that pricing power is structurally reinforced by the recurring CSBG revenue. Once that Lam equipment is installed, they effectively own the high-margin service and spare parts business for that tool for its entire life. The customer can't risk yield loss or downtime by using unproven third-party maintenance or generic components on a tool that is so mission-critical to their success.
Now, here is where the story gets really compelling. And I think this addresses the criticism that the WFE sector is, mature. The moat isn't static, is it? It's actually widening.
It's dynamically widening. And this is driven by the shift to increasingly complex 3D architectures.
This is the core structural thesis for Lam research. It's a concept called process intensity.
It is. We are moving rapidly away from traditional planar chips. You can think of those as single-story houses, and into these complex three-dimensional structures. We're talking about gate-all-around or GAA, technology and logic chips, which stacks transistor channels vertically.
Like a skyscraper instead of a ranch house.
That's a perfect analogy. And also high bandwidth memory, or HBM, which stacks hundreds of layers of DRAM vertically.
So why is that shift from the ranch house to the skyscraper so profitable for Lam?
Because these new complex 3D structures require exponentially more etch and deposition steps. It's that simple. To build a traditional planar chip, you might need, say, 50 to 100 etch steps. To build a modern GAA logic chip or a 200-plus layer 3D NAND stack, you might need hundreds of them, sometimes over 300 precision steps.
So that means more Lam equipment is needed per wafer, regardless of whether the customer is building a whole new fab or not.
That's the beautiful part. Lam grows its served available market simply by the evolution of physics, even if overall wafer starts remain flat.
So as complexity increases, the number of required etch and deposition steps grows dramatically for every single wafer.
And this increasing process intensity further embeds Lam's technology, raising that switching cost barrier to an almost unimaginable degree for customers and for competitors. Because now you have to solve not just one, but potentially hundreds of finely tuned, interdependent processes. The moat just gets deeper and wider with every new technology node.
Let's talk about the industry structure then, which you've often called the iron law of oligopoly in the WFE space.
It really is. This structure is key to understanding the sustained high margins we see. The industry is highly concentrated. It's dominated by three main players: Lam Research, Applied Materials, and KLA Corporation.
And why can't new entrants break in? It seems like a very profitable business.
The structure is not accidental. It's protected by extreme barriers to entry. The primary one is R&D intensity. You need to spend billions of dollars annually just to maintain technology parity, let alone innovate. Trying to replicate decades of specialized, protected intellectual property in areas like plasma physics and atomic layer deposition, it's essentially impossible for a newcomer.
And the competition among the existing players is rational, which is crucial for profitability, isn't it?
It's absolutely rational. Competition here focuses entirely on innovation, on yield improvement, and on technology leadership, not on destructive price wars. It's a gentlemanly competition, and that results in durable, high margins for all three major players. It reflects the immense value they provide to the trillion-dollar end market they serve.
Okay, let's detail that direct competition. Applied Materials, or AMAT, they're the biggest overall player, but they differ strategically from Lam.
They do. AMAT is the generalized powerhouse. Their strategy is broad diversification. They aim to be the most complete solutions provider out there. And they have significant strengths in deposition, ion implantation, and chemical mechanical planarization.
So they are Lam's most direct competitor.
They are, because of that substantial overlap in deposition technology.
And KLA, they're really the quality control specialist.
Correct. KLA is focused almost entirely on process control and yield management. They make the specialized inspection and metrology tools. They are the quality assurance specialists, ensuring the chips made by Lam and AMAT tools actually meet specifications. They are in the main fabrication steps themselves. You could call them the necessary police force of the fab.
So while AMAT seeks to capture the widest possible share of WFE spending, Lam's strategic advantage is its deep specialization.
That's it. It's specialization in the toughest, most complex manufacturing steps. Lam's strategy is to be the undisputed leader in specialized high-intensity etch. By focusing on complexity on the hardest 3D problems where process intensity is highest, Lam can grow its served available market faster than general WFE spending. Their durable advantage is their depth of IP and market share dominance in plasma etch, which is the step that dictates the precision of the final chip structure. And that makes them disproportionately valuable in this new AI and HBM era.
Okay, let's move from the technology to the operational reality. What does the scuttlebutt, the chatter among customers and employees, tell us about the health of this moat?
Well, customer reliance is incredibly high. It moves well beyond simple vendor tolerance to a true required partnership. For the leading-edge chip makers, Lam's performance in etch is absolutely mission-critical to their most profitable product lines.
And the numbers back that up.
The numbers back that up. The market share leadership, especially in etch, and the consistent growth of that high-margin CSBG, it confirms a deep operational dependence. The customer essentially says, we hate paying the toll, but we absolutely need to use this bridge.
And what about internally? The culture has to support this constant cutting-edge innovation.
It does. The R&D culture is the lifeblood of a company that is so dependent on Moore's Law. Employee reviews suggest a strong, albeit high-pressure, focus on technical collaboration and solving really hard physical problems.
And that's a good sign.
It's a great sign. The high level of positive sentiment, particularly within the core engineering department, indicates that the core mission of technical excellence is strong and fully aligned with the company's long-term success.
Okay, that wraps up the competitive fortress pretty comprehensively. Now we need to pivot to pillar number 2, management stewardship and the financial fortress. Because even the deepest moat in the world can be worthless if the management team is, burning cash or making poor allocation decisions.
That's where the rubber meets the road.
It really is.
Yeah.
So when we analyze Lam's leadership, what is the core philosophy? And how does management show they're aligned with the long-term shareholder?
The leadership consistently demonstrates what I'd call an owner-oriented mindset. Their focus is long-term. They are focused on maximizing lifetime free cash flow, not on smoothing quarterly revenue.
So they prioritize R&D.
They prioritize R&D investment above all else, and they align the company's structural investments to capture these inevitable secular trends like AI, HBM, and advanced packaging. They are intensely focused on innovation as the primary driver to expand their served available market share, which effectively allows them to capture more value from the same customer fab.
And that focus is reflected directly in how they get paid in the incentive structures.
It is. Management compensation is explicitly tied to long-term value creation metrics, specifically return on invested capital, ROIC, and free cash flow.
And what about insider ownership?
Well, insider ownership is small, which is pretty typical for these massive, mature tech giants.
Yeah.
But the commitment to consistent capital return and that ROIC focus strongly suggests as a genuine alignment with shareholder interests, which is the key measure we're looking for.
Okay, let's detail that capital allocation track record, which is, I'd argue, one of the strongest in the entire sector. What is the priority hierarchy for deploying all that substantial free cash flow that Lam generates?
It's a very clear, very disciplined three-step hierarchy. Priority 1 is heavy investment in R&D and internal capital expenditures. These are necessary for technology leadership. They view the technology as the moat, so they have to invest aggressively here to maintain that edge, regardless of any short-term economic fluctuations.
So they're not going to starve the R&D budget during a cyclical downturn, which would be a huge mistake.
Precisely. They play the long game. Priority 2 is strategic M&A. This is usually smaller, focused acquisitions that bring in specific niche technology or IP to expand their toolkit. They avoid the massive, transformative, and often destructive big deals. They buy technology to integrate, not just to buy revenue.
And priority 3 is the direct return to shareholders.
That's the highly aggressive capital return. Consistent share repurchases, which are the most efficient way to return capital to long-term investors, and a steadily growing dividend. And critically, we just saw the recent authorization of a massive $10 billion buyback program.
Let's just put that number into context for a moment. A $10 billion authorization represents what? About 8% of the shares outstanding based on recent valuations. This is not just noise, it's a powerful, concrete signal from management.
It's management communicating two things very clearly. First, they believe the stock is undervalued relative to its future cash flows. And second, they have absolute confidence in their ability to generate that massive future free cash flow.
And if they deploy that entire authorization effectively, say, over the next couple of years.
An 8% reduction in the share count provides an immediate structural boost to earnings per share and return on invested capital. It just compounds returns for all the remaining shareholders. It's the behavior of a truly owner-oriented management team.
Okay, so now let's quantify that wonderful business definition by looking at the financial fortress itself. We've talked about the high-margin CSBG, but the overall profitability has to defy the industry norms for a capital equipment manufacturer.
That's the beauty of the oligopoly structure combined with that razor and blade CSBG model. The profitability is high and it's generally very consistent. Gross margin is consistently strong and it's approaching their 50% target. That margin resilience, even through downturns, demonstrates serious pricing power and operational leverage.
But the single most crucial quality metric for us is always return on invested capital, ROIC.
Always. And this is the quantitative proof of the moat that, Buffett and Munger always emphasize.
So what are we seeing in Lamb's ROIC?
Lamb's ROIC is consistently structurally high. It often exceeds 20% and by many measures has been sustained above 30% recently. This is the financial definition of a wonderful business, especially when you consider this is a highly capital-intensive industry.
Wait, hold on. A capital equipment manufacturer achieving ROIC figures that are usually reserved for asset-light software giants. That fundamentally defies the typical capital-intensive business model. How do they maintain that level?
It comes right back to the Moat and the CSBG. They invest heavily in R&D, which is an expense, but once the tools are installed, that's the capital, the high margin, asset-light CSBG revenue just flows in.
So they don't need to continually reinvest mass amounts of capital just to maintain their existing revenue base.
Exactly. The existing customer base is locked in and constantly paying for services. That sustained high ROIC, far above the company's cost of capital, demonstrates two things. A powerful, durable competitive advantage is real, and management executes with superior operational efficiency.
Beyond returns, we always look for high-quality earnings that translate into actual usable cash. That's the free cash flow conversion story.
And Lamb shines here too. FCF conversion from net income is excellent. They typically convert net income almost dollar for dollar into operating cash flow.
So the earnings are real.
The earnings are very high quality. They translate directly into discretionary cash that management can then deploy for R&D, for those buybacks, or for dividends, reinforcing that disciplined capital allocation hierarchy we just discussed. The cash isn't getting tied up in inventory or long-term receivables.
And finally, the balance sheet. In a cyclical industry, you absolutely need flexibility to survive the downturns and maybe even capitalize on distressed opportunities.
The balance sheet is a financial fortress by design. The net debt to EBITDA ratio is typically very low, often hovering around 0.2x to 0.4x. This is extremely prudent debt management. It means there's minimal risk of financial distress, even during a severe cyclical trough, and it gives them maximum financial flexibility.
So when a downturn hits?
When a downturn hits, Lamb is positioned to use its cash, not just for R&D, but to deploy that huge buyback authorization opportunistically, while their competitors might be forced to cut back.
This analysis paints a really clear picture of an exceptional quality business, protected by a widening moat and run by disciplined management. But the investment outcome is always determined by the intersection of quality and price.
Always.
And that brings us to pillar number 3, valuation, risks, and catalysts.
This is the ultimate hurdle, isn't it? Lamb Research historically commands a premium that reflects its quality and long-term growth, but it is perpetually subject to the notorious WFE cycles. The market has to constantly reconcile the reality of a wonderful business with the volatility of a cyclical industry.
So where does the valuation stand today? particularly reflecting all the AI-driven optimism around HBM and GAA.
Currently, the stock trades at a premium PE ratio, roughly around 34 times trailing earnings. This is reflecting significant market optimism. Investors are pricing in a very, very strong future, powered by AI infrastructure build-out and that increasing complexity we talked about.
And what does buying at 34 times PE mean for an investor's future returns? I mean, is that ever justified?
It is only justified if you believe that future earnings growth will be aggressive and sustained. We're talking 20% or more, consistently, just to generate average market returns from this point. There is almost no room for multiple expansion at this level.
So your entire return is dependent on growth.
Your entire return is determined solely by the growth rate of free cash flow. If that growth comes in lower than anticipated, or if the next cyclical downturn is deeper or longer than expected, the valuation multiple will contract and probably contract sharply. And that would lead to poor returns despite the underlying quality of the business.
That really highlights the importance of timing in cyclical stocks, even ones that are this high quality.
Absolutely. Think about it. The investor who bought Lam Research at a low PE during a cyclical trough in the past, when the market narrative was bearish and the stock was priced for catastrophe, that investor generated outsized returns.
Because it got two things.
They got two things. They benefited from both the earnings growth and that massive multiple re-rating as the cycle turned. Buying at today's premium means you have to be highly confident in the duration and magnitude of these secular tailwinds and that the company is going to hit that 20% plus growth target.
So if the price is at a premium, where's the margin of safety? It's clearly not in cheap trailing earnings.
No, it's not. The margin of safety here is fundamentally based on two non-price factors. First, the certainty of the long-term secular trend, the inevitability of Moore's law. And second, the sheer quality of the business itself, which is backed by that high, durable ROIC we discussed.
But a true price margin of safety, what we often call a cyclical discount, that would only emerge under a couple of specific and probably painful scenarios.
Exactly. Scenario one would be a broad-based semiconductor cyclical panic. This is where a WFE market downturn causes a temporary, dramatic stock drop. We often see 30% to 50% drops in these cycles, despite the fact that the company's underlying high ROIC and fortress balance sheet remain completely intact.
This is the baby out with the bathwater moment.
It is. It's when the market panics because of short-term revenue contraction, and for a long-term compounder investor, that is a gift.
And scenario two, the structural threat that can override technology leadership.
A geopolitical blowup. A temporary but severe escalation of trade tensions or export restrictions, for example, a sudden tightening on China exports, that causes a massive temporary price dislocation and panic selling.
But the key word there is temporary.
It is. The dislocation is temporary, but the company's core technology leadership and its non-China business remains fundamentally healthy. The price recovers once the shock subsides, but you were able to buy in at a discount.
Okay, let's discuss the key growth engine. What's driving that aggressive future earnings growth that is required to justify a 34x PE?
We have to anchor back to the main thesis. It's the increasing process intensity required by new semiconductor architectures. That is the primary engine. The shift to high bandwidth memory for AI and the permanent transition to gate-all-around logic demands significantly more Lam equipment per wafer than previous generations did.
So this process complexity means Lam is structurally less dependent on broad macro WFE spending.
Right. It can grow its revenue base even if competitors who are relying on general volume growth struggle. They are targeting the most profitable, fastest-growing segment of the physics stack.
And we can't forget the secondary driver, the CSBG, which kind of acts as a flywheel.
Correct. The stable, high-margin growth in the customer support business group provides a structural tailwind that continuously mitigates the overall cyclicality and supports the long-term compounding rate, regardless of new fab construction. It is, in effect, an annuity built on their past success in equipment sales.
Okay, before we get too bullish on the compounding power, we have to address the permanent impairment risks, the threats to the moat that are non-negotiable and, frankly, existential.
The first, and I would say the least likely due to the complexity, is fundamental technological obsolescence.
What would that look like?
Well, what if a competitor or an entirely new entity develops a disruptive non-etch or non-deposition-based fabrication technology? A completely different way of creating circuits, perhaps using directed energy or self-assembly, something that renders Lam's proprietary IP and its installed base obsolete. That's a permanent risk, though it's one that's mitigated by the industry's historical reliance on incremental innovation building on existing physics.
The second one involves the dynamic of their powerful customer base.
That's customer consolidation or vertical integration. What if the major chip customers consolidate dramatically? Or even worse, what if they decide to manufacture their own WFE equipment internally?
A scenario where a giant like TSMC or Samsung just decides to build their own etch tools.
Exactly. While that has historically proven to be incredibly difficult if it were ever realized, it would permanently reduce the total addressable market for external WFE suppliers like Lam.
And the third, the priority risk, the geopolitical threat that hangs over this entire sector.
This is the big one, and it deserves the most detail. Geopolitical deglobalization. The threat here is a sustained, severe decoupling of the U.S.-Taiwan-Korea semiconductor supply chain from the vast Chinese market. This is not just a temporary slowdown in sales due to export controls. This is a permanent, structural loss of a significant portion of Lam's historical revenue stream and a fragmentation of the entire technology ecosystem.
Historically, China has been a massive market for them. It's been essential for volume and for cash flow. If, hypothetically, Lam were forced to permanently withdraw or face strict limits on sales to major Chinese customers, what is the implication?
The implication is it's catastrophic, even if the non-China business remains strong. It means a permanent impairment of the total addressable market. But even more critically, it catalyzes the growth of state-sponsored indigenous WFE competitors within China.
Because they have no other choice.
They have no other choice. If Lam is unable to sell its latest, most advanced tools, Chinese competitors gain a protected space and the time to develop their own systems, which then could erode Lam's future global market share. The core threat here is that geopolitical constraints override technical superiority. It proves that the moat is only as strong as the political system allows it to be. This is an existential threat to long-term growth expectations.
Okay, shifting gears. Let's identify the near-term accelerants, the catalysts that could help justify that current premium valuation and accelerate earnings.
There are two main near-term catalysts we're tracking. The first is the HBM AI ramp. We need a faster than anticipated transition to high bandwidth memory and GAA logic. This will directly translate into higher demand for specialized etch and deposition tools, where Lam holds an outsized share of that specialized budget.
So it accelerates the process intensity thesis from theory into reality.
Right. And it pushes up revenue faster than the market expects. The second catalyst relates back to management's explicit commitment to capital allocation.
The buyback.
The buyback. Aggressive capital return. If management swiftly and aggressively deploys that massive $10 billion share repurchase authorization, which again is 8% of the company, particularly if the stock experiences a market dip due to cyclical fears, it provides a crucial floor to the valuation and an immediate noticeable boost to earnings per share. The combination of that technical acceleration and financial engineering is a very potent short-term cocktail.
Finally, we need to apply second-level thinking to contrast our detailed analysis with the general market consensus. What's the sheet saying?
The broad market consensus is typically a moderate buy. It acknowledges the long-term AI and HBM tailwinds and views Lam as a high-quality name, but ultimately it deems the current valuation as fairly valued or slightly premium because it still treats the stock primarily as a traditional cyclical WFE player.
They still see the peak in the trough.
They do. But our analysis suggests that that is an incomplete picture.
So what's the contrarian view?
Our contrarian view emphasizes that the market is underappreciating the widening of the moat that's being driven by increasing process intensity. We believe Lam is becoming structurally less cyclical and more of a secular compounder than its traditional WFE peers. That's due to the CSBG stability and the sheer architectural complexity of new chips.
And the ROIC backs that up.
The high, durable ROIC, which is not typical of a deeply cyclical equipment manufacturer, suggests this is a fundamentally higher quality business whose future growth rate is likely to be sustained for longer than cyclical models are currently predicting.
This has been a tremendously detailed analysis. To synthesize all of this for the listener, let's put together our final investment memo summary, starting with the core bull case highlights.
The bull case is compelling. First, the indispensable Tollbridge moat. They dominate specialized etch, creating massive switching costs over the most critical steps of chip manufacturing. Second, they are a secular compounder with direct leverage to AI and cloud growth through that increasing process intensity, insulating them from general WFE volume dips.
Third, the financials.
Third, they possess a financial fortress high consistent ROIC, strong FCF generation, and a flexible balance sheet built for opportunistic deployment. And fourth, the high margin recurrence provided by the CSBG, which reliably mitigates that overall cyclicality.
Now, the bear case highlights the counter-arguments that the investor buying at 34 times PE must seriously consider.
The bear case centers on three critical points. First, extreme geopolitical exposure to evolving U.S.-China trade restrictions. This represents a highly leveraged risk of permanent revenue loss and the fostering of new competitors. Second, the inherent WFE cyclicality means that despite the long-term trend, large temporary earnings drops and corresponding stock volatility are inevitable and must be anticipated.
And third, the price itself.
And third, the high current valuation. At around 34x PE, there is minimal margin of safety for error or cyclical setbacks today. The investor is paying for perfection.
We always end with a red team challenge, the single most compelling argument for why an investment, even in a quality business like this, could fail. We use the inversion technique here to isolate the highest leverage risk.
The challenge we pose to you, the long-term investor, is this. If geopolitical risk materializes into a permanent, deep bifurcation of the semiconductor world, your investment will fail to compound at the rates you expect. Period.
What does that mean in practice?
It means if escalating trade restrictions force Lam to completely abandon major markets, or worse, catalyze successful state-sponsored indigenous WFE competitors that can bypass Lam's technology, its total addressable market would be permanently and dramatically impaired.
And the implication of that is that this risk is existential.
It is. It would force a massive multiple contraction immediately, proving that the perceived technological moat, while incredibly strong in a free, globalized market, is ultimately subordinate to global political risk. That is the one critical macro factor the long-term investor must continue to monitor above all else.
A perfect summary of the highest leverage risk facing this indispensable industry. Lam Research is a wonderful business, but buying it at current valuations requires deep conviction in geopolitical stability and the continuation of that process intensity thesis. Thank you for walking us through that exhaustive deep dive.
My pleasure.
For those of you who want to track this wonderful but cyclically challenged business, don't forget that affiliate link to Interactive Brokers is right there in the description.
And please remember to subscribe and like the video if you found value in this deep dive. Your support ensures we can keep bringing you this level of analysis.
Until the next deep dive, keep compounding and stay curious. We'll see you then.